Good afternoon, and welcome to the AFS Best Practices Leadership Webinar. Thank you for joining us. Our topic is LIBOR Transition, the Arrival of Alternative Rates. Our host today is Dean Snyder. Before we get started, there are a few items so you know how to participate in today's event. We do have a couple of polls, and we would ask when you see the polls to please participate. Your responses are anonymous and won't be seen by the attendees. We do encourage questions. Please use the Q&A feature to ask your questions. We will leave time at the end of our prepared remarks to answer as many questions as possible. And finally, we are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Dean?
Thank you, Renee, and welcome everyone. Welcome to the first day of fall 2021. And we're pleased to share with you our latest updates about the LIBOR transition. And as you can see, we'll talk a little bit about where our AFS clients are in the process, some of the latest announcements from the ARRC. Charles is going to talk to us about credit-sensitive rates, show you a little bit about capabilities we have to support those, and we'll wrap up with a summary at the end. So as we proceed, go ahead, Lisa. As you can see, in following our AFS client base, everyone's asking, how are we doing? Are we in line with the market and so forth? You can see that about 70% of AFS client banks are up and running and ready for all forms of SOFR and other alternative rates. And there's a smaller percentage that are either still in the process with target dates between now and the end of the year. There's 10% here that I think we just don't have current updates on that. So not to say that 10% may not be ready by end of year, but some that we don't have all of the data in. But it gives you an idea that the vast majority of the AFS clients are up and running, I say ready to go or already going with the alternative rates to LIBOR. Some of the recent issues that had been kicked around in the market and with the ARRC revolved around the Good Friday holiday, which we had determined was going to be supported through individual calendars, depending on what your processing calendar would look like. And there were some outstanding questions about floors and how floors would work, how they would work on loans versus the derivatives. And there was, I think, some agreement and pronouncements about the legacy LIBOR carrying over unless there is a change to that credit agreement. So I think there was resolution on these issues. As far as how's the adoption going in the market, and we looked at our data that we have from various banks around the country, and I think this represents close to 1 million individual loans, and you'll see the data on the left side to give you an idea in terms of dollar amount of loans that are being issued or have been issued that are tied to some form of SOFR. You can see a dramatic increase in the chart over the last several months, and we expect that trend will continue. However, on the right side, just to keep it in proper perspective, you'll see that as you look at SOFR with respect to all other variable rate, floating rate type loans, again, a sharp increase in the numbers, but the actual total you'll see for August of 2021 is still at about 50.57%. That's not 57%, that's less than 1% or 0.57 of 1%. So again, from an overall percentage basis, it's still very small, but the trend is showing a dramatic increase, and we would expect that to continue. So we thought we would ask our audience, and this is obviously a subjective question, right? That trying to understand the market preparedness. How would you describe your borrower's understanding of SOFR and the other alternative rates? And this is not the banks, this is not your operations, your lines or so forth. This is your actual borrowers. What would you think? Are most borrowers very informed now about the transition from LIBOR? Are they adequately informed, or are there still that just aren't prepared or don't have a clue? So the poll is open, and we encourage you to indicate what your thoughts are around the borrower's understanding, the borrower's preparedness for the change that's occurring. And Renee, I'll let you let me know when you've got some results.
Yes, I will do that. I'm going to give it another few seconds, and then I think we can close the poll and see what we see. All right, I'm going to go ahead and, getting a few more. All right, looks like we've slowed down. So I'm going to go ahead and close it, Dean.
Okay.
And here are the results.
That's a very interesting set of results to think that the borrowers are still not very informed on this whole topic, and more than half or 56% say are not really prepared at all. So interesting feedback to get from our audience today, and I'll let you interpret those results as you may. I'm now going to turn over the updates to Charles Wamboa, who's going to talk about what's happening with the market and with the latest ARRC updates.
Thank you, Dean. Can you hear me, Dean?
Yes, go ahead, Charles, you're good.
All right, thank you. And good afternoon, everyone. Actually, I like the answers that I saw from that poll, even though the highest response showed that the borrowers are not very adequately prepared because of the complexities that we've been hearing with the different SOFR variants. But then if we look at the recent confirmation from the ARRC, whereby at the end of July, they formally endorsed the Chicago Mercantile Exchange term SOFR. That must come as a big relief to most of the market participants that were waiting for a term SOFR, because when you're explaining how that rate will be switching from LIBOR to a term, for example, if you choose to go with the term SOFR for your loans, then it's going to be an easier conversation to have with your borrower. With that said, we do know one of the ARRC principles, while they were recommending this rate, was to have a limited scope of use. One of the reasons being, and I'll quote them, to avoid use that is not in proportion to the depth and the transactions in the underlying derivatives, or avoid use that detracts from the volumes in the underlying SOFR-linked derivative transactions that are relied upon to construct this term rate. So, because that means that there's a potential to make this rate unstable over time. So as much as the market is relieved to have this term SOFR endorsed, as time goes by, I think we'll see a limited use. Now, I don't know how that will be managed from conversations that we're hearing. Even though that is the recommendation, the question still remains, who will actually limit or make sure that the uses has been limited? So that's still an open question, and as conversations keep going on in the market, we'll have a more definitive answer. Now, what we've heard recently is the ARRC saying that they do recognize some end users may wish to hedge their cash products that reference the term SOFR with a term SOFR derivative to get a closer matching hedge or to make their operations more simplified. So that's one thing. Now, the reason I'm saying that at the end of the day is to stress on the end user. I think that might be one of the ways to limit the use. And so they said the end user is considered to be a direct party or guarantor to a new Term SOFR business loan, or a security linked to Term SOFR assets, or to a legacy LIBOR product that has converted to the Term SOFR through the fallback language. Now, the end user, when I say that, is when we say that a direct party is the borrower, your agent, and your lenders, right? And it stops there. I know there could be other parties linked to it, but they stressed on the people, or rather the parties that will be using this Term SOFRs for now are just the end users only. Now, as far as the consumption of the term rate that is coming from the CME, I know there might be other term rates that will pop up in the market, but the one in specific with the CME, some of the questions that are being raised are around licensing. For now, the CME has said that they will be waiving their licensing fees up until 2026, but then you still need the license, right, to consume those rates just like you do with LIBOR today. And I know a lot of you might not know that you actually had to pay a license for it just because we've been using it for such a long time. But yes, there was licensing fees related to LIBOR that had to be paid out to ICE, I believe. So that's something that I want to throw as a general question just for everyone to think about. And we can discuss it further at the end of this presentation, just because we also need, as a vendor, we also need to be well informed around that. And you as the clients who are actually getting these rates and feeding them into the AFS platform, we will need to definitely partner with you to make sure that everything is in order in terms of any requirements or licensing that are needed as we manage loans on our platforms. So we can discuss, just think about it, and then we can discuss it at the end of this presentation. Also, we did see Refinitiv. They got, I think, an endorsement to also publish the spread adjustments or just the rates in general, the SOFR rates in general on their platform. So that comes as good news. I know, one thing I know is, as we've been talking about all these SOFR variants, there have been questions around lockout, look back, observation shift, 2-day observation shift. Are you going to use observation shift or no observation shift? All those questions, all those rates and how they're calculated. If you actually now go to the Refinitiv website, you can, they've done the work for you, because you'll be able to see different tenors of SOFR in the different variations of lockup period, observation shift, look back days, spread adjustments or no spread adjustments. All those rates are now available for you to consume directly from the Refinitiv website. So if you've not got a chance, please go there and play around with the rates as you continue to do your testing or familiarizing yourself with how these loans will be managed with the new rates going forward. Also, the LSTA recently published, after the announcement of the CME Term SOFR, they recently published Term SOFR concept credit agreement. So for those on the legal side, you can reach out to their website. You should be able to download it and just use that document more so as a guide of how to structure your new language and your new credit agreements that reference the Term SOFR rate. Okay. Synthetic LIBOR, we know it's been a concern for some of the market participants based on some of their loans that they believe will be difficult to transition simply from LIBOR to another alternative rate because of the language that was set originally in the agreements. It did not give room to switch to another rate because I guess they did not foresee LIBOR going away. We do know sometime back in April, Governor Cuomo signed legislation into law that will help minimize the legal concerns. So that should be helpful, but it remains a concern in terms of how that synthetic LIBOR will work, because some of the conversation I keep hearing is, as much as we call it synthetic quote unquote LIBOR, that rate is actually a SOFR rate. Now, does that open room for some legal problems? I don't know, but your teams on the legal side should continue looking into that, because from something I read, I think it said even though 70% of the current LIBOR loans should mature before June 2023, we still have about $70 trillion that are expected to still remain outstanding after that deadline. So that's a lot. There's many contracts that still need to be amended or sustained with this synthetic LIBOR. So if you have more information around it, please feel free to reach out to us to see how we can assist you from a vendor perspective in terms of managing those loans that will not transition. All right. Another update on SOFR from the LSTA is on cost of carry. On the LSTA side, or rather the US side, Ellen and team are working very hard to give us a very simplified method of calculating cost of carry. We're trying to have a standard methodology like we have today, whereby if I'm looking at our LIBOR contract, which has, the loans could either be in LIBOR or could be using the alternate base rate ABR. They all use a 1 month LIBOR rate when calculating the cost of carry during the delay period. When we go into the SOFR world, the question is, you'll still have some loans with LIBOR or ABR. How are you going to treat these other loans with SOFR? What are you going to use? Average SOFR? Are you going to use average compounded rate? Are you going to use term SOFR average? All those have been questions that have been raised. But then recently, I believe last week on Monday, when the documents were published by the LSTA, they mostly changed the primary allocation confirm, the par confirm, and the distress confirm. You'll still see many other trading documents that were printed out, but those three were the main ones that were changed, or rather amended. So the updates to that, which just cross your fingers, but expect that to change sometime in January 2022. But currently, as of September, the LIBOR and the ABR, they'll continue using the 1 month LIBOR. If you have a trade that is tied to a daily alternative reference rate, which will be SOFR, for example, right? The daily simple SOFR or compounded in arrears SOFR, they will use the daily average SOFR. So they will use your daily SOFR rate, even though one is compounded or another one is compounded in advance, compounded in arrears, or daily simple. They will all use the daily SOFR rate and get the average of that. If you have a SOFR, term SOFR, which in this case will be your CME for now, even though it's a term SOFR, when it comes to your cost of carry calculation, you will use daily SOFR rate. So that's important to note, because I know it's going to confuse people when they start doing these trading calculations. If you have credit sensitive risks, right? Credit sensitive rates rather, right? You might have a Maribor, you might have BSBY. When calculating your average, you're calculating your cost of carry, you'll also use daily SOFR in your calculations. Now, especially the last two statements with the term SOFR and the credit sensitive rates, I expect, because this is just very recent, I expect questions to really come out and go to the LSTA. If people have concerns, you please raise them if you do. But we think the fact that we're being given one methodology, or rather one rate to use when calculating cost of carry across the board for the US market, it makes things simple. If you find it confusing or difficult, let the LSTA know, because there's still room to have these changes made by end of year or early next year. And what you should expect will be, the change that you should expect will be, all loans on the US side will just use average daily SOFR plus a fixed spread, not your not the spread adjustment that we keep talking about where we're talking about regular SOFR. No, this will be a fixed spread across the board for all trades that will be added to your SOFR rate. Okay. All right, next slide, please. Okay, so credit sensitive rates have really been, especially this year, I'll say, they've really been in most of the conversations, because as banks or just clients in general are reviewing their books or their loans, they were concerned about the credit sensitivity component not being available with SOFR. So all these other rates have been popping up in the market to act as a replacement or as an add-on to SOFR. So I'll start with one that we all know by now, the BSBY one from Bloomberg, that has an overnight, a 1 month, 3 months, 6 month, and a 12-month tenor. So the way the BSBY acts is it acts more like LIBOR, so you can just take it as a standalone, pop it into your loan, and add your margin and calculate your interest. But then if you really listened to last week's ARRC symposium, the SEC chairman talked about this rate being a concern for him just because it mirrors LIBOR and therefore may carry the same risk that LIBOR had that got us to this point that we are in today, trying to replace it. And the main concern there was the rate being able to be manipulated. So as much as him and others have talked about this concept of, or this potential of manipulating these rates, especially with BSBY, I don't know why, not picking on BSBY, but then Bloomberg themselves heard the same concern. They went back in, looked at their data, and tried to manipulate it. They tested it, tried to manipulate it to see, how much the BSBY rate would move if someone took action and tried to do something funny. But they came back and said the rate did not move significantly. It was very small, immaterial. So another reason I heard from them was, before it's the people that were setting the rates for LIBOR, right? It was what, a 16 panel bank. 16 panel bank. And so most of them were all on the same side, right? They're mostly broker dealers, right? So they were on this, most of them were on the same side to gain. So if the rate was manipulated, but what they're saying with Bisbee, for example, the money markets involved with this rate includes many buyers and sellers who do not sit on the same side, right? They're on opposite ends. So it makes it difficult for someone to manipulate the rate for a mutual gain. So just wanted to point that out as you keep looking at other rates that are being talked about in the market and if they're really going to be feasible. But from an AFS perspective, we can handle, right? It's a rate, and depending on how it's used, so far we've done studies to make sure that we can support them. The next one that you might have heard by now, or should have, is across the curve credit spread index, the AXI. It's a forward-looking term credit sensitive spread that is added to SOFR, right? So this is not a standalone. It's a rate that you add to the existing SOFR rate. And the rate is a weighted average of credit spread for unsecured debt with maturities out to 5 years. So, and it reflects both transactions and issuance volumes. So there's another rate. I believe they have some, you should see some, I believe on the LSTA, there is a podcast or a webcast out there that you can listen to if you want to get more information around this particular rate, or go directly to their website, but it's also available. IHS Markit. So with IHS Markit, they came up with two rates. They have a credit inclusive term rate and a credit inclusive term spread, right? So those are two different rates. So you can use the credit spread and apply it to SOFR compounded, right? So you're adding it to the existing SOFR variance, right? The average SOFR, your term SOFR, right? Or any other rate that you have out there that you plan to use as an alternative rate, but it doesn't have a dynamic credit component to it. So you can use a credit inclusive term rate and add it to that. Or rather the term spread and add it to your SOFR rate. Or you can choose to use the credit inclusive term rate as a standalone rate, right? So you do not need to use SOFR for the credit inclusive term rate. It stands in as an all-in rate, or rather a rate by itself, and then you add it to your margin, credit margin, you get your all-in rate and just calculate interest like you do today with LIBOR. Their tenors are 1 day, 1 month, 3 months, 6 months, and 12 months. Now, even though these rates are available, the IHS Markit rates, they're only there for, they're not official, right? They do not have regulatory approval as of yet. So in that case, IHS Markit is not currently offering any licenses for you to use this rate in official capacity. But you can go in, look at the rates, and just use them to better assess your portfolio and how those rates function and if they're suitable for your particular book, loan book rather. Okay, another rate out there is the BYI rate, the ICE Bank Yield Index. So this was introduced by the IBA back in 2019, and it measures the average yields at which investors are willing to invest US dollar funds over 1 month, 3 month, and 6 month periods on senior unsecured basis for large banks. Another thing to note here with this particular rate is, at this time, there is no guarantee that IBA will continue to test this rate and publish in the near future. So as much as we're looking at the moment, you can look at it as an option. Do not rely on this rate to continue being published in the near future. So when you're analyzing your books, once again, that's something to keep in mind. Maribor is another rate, mostly on the US side. It's owned by the American Financial Exchange. And one thing about this rate that I like is the fact that it's posted on the blockchain, right? So, you know, blockchain, you know, we look at it like a sort of public ledger that, you know, everybody can view. So basically what they're saying, the reason why that they did so is just to enhance transparency in the market, and not just for the market participants, but also for the regulators. So also this index is an index of the credit weighted average of its members, right? So not that of its own members, unsecured loans, and thus more sustainable for small and mid-sized banks that are less likely to use secured loans. So that's important. So when actually this whole concept of credit sensitive risk or race came about, it actually started, the conversation mostly started with the mid-sized banks that, you know, they brought this to the regulators' attention, and they were asking for this credit component. And that's how, you know, Maribor came into place as a suitable alternative to SOFR. At this point, at this time, it only has 2 tenors that I know of. They have the overnight and the 30-day tenors available. Next slide. And here is where I want to show you how AFS Vision in specific handles, although this is also on the other platform, level 3, but from a vision perspective, what we normally do is, for those who are users, you can go into system admin, whereby that, you know, that sits at the top of the hub of the system, for where you can enter all sorts of indexes. And in the LIBOR world, you're just used to having your LIBOR rates feed in into Vision and then flow down to your particular loans, and then you will add your margin, and then you get your all-in rate, and that's it. But now, especially with credit sensitive rates, as I was talking, I said some of them are standalone and some of them are an add-on to the SOFR rate. So in Vision, we have this relationship functionality, whereby if you look to the right of my screen, I have a yellow highlighted field where it says sum of. If I was to show you the drop down, you know, it also says, you know, higher off, lower off, average off, but I'm showing you the option of sum off just to show you that we can take these add-on credit sensitive spreads and add them to, excuse me, add them to a SOFR rate that you already have in the system. So you can feed 2 indexes. You can feed your SOFR from the Fed website, Refinitiv, or Bloomberg, and you can also feed your rates, your credit sensitive rates from Bloomberg or IHS Market, for example. If you want to use their add-on, you can feed them into the system. And on the left side, as you can see, the different names, you know, SOFR 2021. You can also have another rate for the IHS Market, for example. Let's go to the next screen, please. Okay. Now, if you look at the right side, the right half where at the top it says relationships, when I add those 2 rates, so here I have SOFR daily published rate that is being pulled in, and SOFR IHS Market credit sensitive rate. When I selected sum off, in system administration part of the system, it will combine those two rates, and the sum of that will flow down to your loan as the combined number, the sum of already. So if you look at my left side of the screen on the second column, where it says published rates, that published rate will not be the published rate that you see coming from the Fed website. That will be the sum of what came from the Fed website, what came from the IHS market or Maribor, if you were to combine those two, and it will give you the final result, which is the sum, and then the system will take over the process of compounding that rate, hence the effective rate, cumulative compounded rate, et cetera, until you get to your all-in rate. So that was to show you that vision. We've been listening to these market requirements around credit sensitive rates, and we still have potential. If something else comes up, like someone might say, no, this particular one, we need it to be an average off, we can handle that too. So, but from what we've been hearing so far, most of them are either standalones or add-on rates, and vision can support. Okay. For the next part of this, back to Dean. And let me know if you have any questions, or you can hold them until the very end. Thank you.
Thanks, Charles. So Charles has taken us through the different alternative rates are now being offered. So I wanted to take a minute to go back to the beginning of this whole LIBOR transition process, when originally we were looking at daily SOFR rates and the question of compounding. So those questions around the market today now are, will the compounding and arrears calculation methods be used? How prevalent will that be? Or will the alternative reference rates that Charles just went over become more predominant? So asking you to give your opinion here as to, for your alternative rate loans with SOFR, do you think most of them will be compounded in arrears, say more than 50%, 25 to 50, less than 25%, or you're not sure there's going to be any compounding in arrears done now that there are so many alternatives? So Renee, I assume you have the poll open so people can be casting your vote. And again, we wanted to get your perspective on what you're seeing, what you're hearing around the SOFR rates and the interest methods, and especially the compounding arrears, because we know that was the most complicated and has required some enhancements into the loan systems and enhancements to your billing statements, and has other impact, I think, operationally to the bank. So we wanted to get a new poll here today of where you think the market is for compound and arrears. So Renee, do you have some results for us?
I do, Dean. I'm going to go ahead and close the poll and let me share the results.
So you can see there's been a considerable shift from a year ago, when we thought that we were going to be doing a lot of compounded and arrears loans, and now the vast majority is saying that it will be less than 25%, or even half the people saying there will not be any compounded and arrears used. So this does align with what we are hearing and seeing in the market. So we appreciate your feedback on that. I want to go to one more slide here today about just terms around SOFR and conventions, and just kind of a reminder, a level set, that because we do see different terminology being used with this, that we'll be using a business day convention, which is the same date convention that LIBOR has used. It was also referred to as the modified following business day convention, where a rate change will not fall on a non-business day. It will go to the next day or to Monday of the weekend, unless that's a new month. And if that's the case, it will revert back to the Friday or the previous business day. so that it doesn't take you into a new month. So that's going to be consistent with what the market's been doing with LIBOR over the years. From a calendar basis of what is a business day, non-business day, SOFR, of course, follows the SIFMA calendar because it's a security-based rates that are being used. The idea of look back will be, we had here 2 days, 2 business days. As we said originally, it could be a different number. 2 business days is the standard, I believe, the market's going to be using. The notice period is a 3 business day period for borrower notification about rate selection. From a rounding standpoint, the SOFR rates being published to 5 decimal places, so we don't see that as an issue for anyone. Obviously, dollar amounts are going to carry the 2 decimal places, and we think there's not going to be any new rounding process introduced here. It's really going to follow the processes that have been in place with LIBOR up to this point. We've also noted that the Fed does publish the daily SOFR rate and publishes what we call the daily SOFR average rate, or 30, 90, 180-day average rate. This is a published average rate that can be selected and used. It does not require you, the lender, to do the average calculations. It's something that is provided by the Fed. So I think there was some, I'd say, confusion or questions about averaging and doing averaging of rates, and it really is a terminology thing, I believe, around what they refer to as an average rate, but it is published on a daily basis. And Charles mentioned already the term SOFR being maintained by the CME group with 1, 3, 6 month term rates being offered for that. So wanted to give you that reminder. At the end of our material today, as we bring up our upcoming webinar list, I wanted to open up the floor now to see if there are any specific questions that anyone has. Renee, are you the moderator for questions today?
I am. We have a couple of questions already queued up.
Okay.
First question we have here is, why does Refinitiv need to publish the spread adjustments if they are fixed now?
Charles, do you want to field that one?
It's just another vendor being given the opportunity to publish them depending on where you choose to source your rates from. But like I also said, they're not just publish them on the screen, they also add in them and using the lookbacks and all that stuff to give you an easier way to consume them. So when you go onto their website, you'll be able to see the distinctions that they have with their various rates.
But they're not your only source, right, to get that information, right, Charles?
Yes, because you have Bloomberg as well, and you also have the Fed website. So there are many sites that you can source those rates, but ARRC chose them as one of the endorsed vendors to be able to publish their rates.
Okay. What's next, Renee?
All right, so our next question that we have is, considering the federal regulators have said that supervised banks must end LIBOR origination as soon as practicable, and in any event no later than December 31, 2021, does AFS plan to lock out the ability to originate new LIBOR deals after December 31st, 2021 in their system?
That's a good question. I know that came up from some individual clients just recently. So I can tell you up to this point, we had not had that on our target list of something to lock down because we thought that was a process that's already in place within the banks, how they control what rates are offered and when. So certainly if there's more interest in that, we would welcome that and something that we can certainly discuss. Any others, Renee?
Excuse me. Nope, that is it, Dean.
If you want to go back, Lisa, so just a reminder of upcoming events for AFS. We have some joint events with the RMA showing the credit risk navigator at the end of September. We'll have our next pricing fundamentals review at the end of October. And then, wow, we're already into November then. There will be additional sessions on the credit risk navigator product and service that's being offered. As always, if you have any feedback, let us know. I think we might be winding down with our regular LIBOR webinars as we're finally getting to that good place where the transition is underway and happening. We'll continue to update you through our various social media sources and encourage you to follow along with those. And as any important market developments occur that would warrant another full webinar, we'll certainly schedule that and let everyone know. So thank you everyone for your time today. Thank you, Charles. Thank you, for Renee. And again, have a good rest of your day. Bye-bye.
All right, thank you.
Bye. Thank you.